I think for us, I see a big shift in the marketplace coming. I think it's going to come after the presidential election. That's my personal opinion. But what's going to change is a lot of things from the last crash. So I'll give you an example. There's a lot of institutional money in the marketplace. So a lot of asset classes are going to have that backstop of the institutional money. That didn't exist last time. You had homeowners who were hanging on by a thread. Now you've got a huge amount of money supply. So when people talk about the crash, that's really not a fair statement. Different classes are going to fall at different rates. Ultimately, if you've got economics 101 and demand falls, all other things being equal, price will come down. But specifically in the asset classes where institutional money is involved and cheap debt, they're not going to crash. At the end of the day, if you got, even if a balance sheet's upside down, but you've got an owner who's cash flowing, they don't care, right? Or if you've got Wall Street who owns basically the subdivision, they've got very patient money. So even if the market around them's collapsing, but the timing's wrong, they're not going to sell at the low point because they don't have to. So where I think there's going to be a big gap in the market for us, which we're ramping up for, is the stuff that the hedge funds are not buying. So it's funny, I've always been trying to do things that not everyone else is doing. Everyone's buying apartments right now, right?
Right.
So I think that market's saturated. And what's funny is my partner, Tim, is buying every apartment in sight. And this is where the world's a beautiful place, because when you become really good and find a niche at something, you can buy stuff and beat the market. And he's able to beat the market because he's got such a big reach nationally to be able to get stuff at wholesale. But I look at the market price of a listed apartment building, I don't want to touch any of it. I mean, they're advertising stuff in California at 3 and 4 caps, and even in the Midwest and just markets that don't really excite me at 7, 8 caps and with a straight face. So for me, I have no interest in that.
Oh, and the beauty part is when you're advertising a 7 or 8 cap and then you underwrite it as a buyer, you're like, how did you even come up with a 7 cap on that?
Exactly. Because the numbers are very far reached. They're talking about projected rents and all sorts of crazy things.
Oh, everything's performance. Yeah, it's just
exactly. But what I do think there's going to be a big shift in the marketplace on this, where I made all my money in single family, which is people don't realize, C-grade assets, working class neighborhoods that were financeable. And here's a key I'm going to give everybody that will make you tens of millions of dollars. If you're going to buy a rental that's a single family asset, make sure that the area and the asset are going to be financeable.
Right.
Why? Because now you got an exit. If you buy in an area that's not financeable or an asset type where you don't fix it up correctly, your only exit is to sell to another investor.
Correct.
That's your only exit. So that's where we always bought stuff in areas that were good working class neighborhoods, neat yards, pride of ownership, block houses, 3-bedroom, 2-bath, or 4-bedroom, 2-bath, stuff that an end user would want to buy, but we bought at the low point in the market cycle and sold at the high point. And that really is the formula. Single family rentals in a flat market are not that exciting. Why? Because instead of buying an apartment building with 100 units in one place, you have to buy 100 houses spread out. But if you can buy those 100 houses spread out, start day one with a 20% cap rate, and then on top of that, you've got a 200 and 300% appreciation. That's pretty exciting to me. So,
absolutely.
That's why I like houses.
Absolutely.
I love houses.
And to explain to everybody at home the way we're talking about a non-financeable house, even though banks aren't allowed to do it, that redlining, where they'll basically redline around the area and say, we don't make loans in these neighborhoods because they've taken such a beating in the past on them.
Correct.
And I know exactly the neighborhoods you're talking about. They won't come out and say, we won't lend because of that house, but they're going to have a million other reasons not to lend.
Yes, it's a war zone. So what we found, and I'll let you in another clue about what not to buy. If you buy war zone properties, and there are landlords that do that, it's a grind. It's a grind because you'll never sell for anything. So there's no real upside to that asset. Number two, you got a huge turnover because no one consistently, unless they're operating on the wrong side of the law, typically don't want to stay in a neighborhood like that. It's a transitional neighborhood by nature. And the repair bills, when tenants do move out, we found to be a lot higher. So we just don't buy in war zones. We buy in C+. That's what worked really well for me. And everybody ultimately has to go off their own personal experience. But buying financeable assets in financeable areas at the low point in the market has been the magic formula. And next market cycle, I intend on buying thousands of homes statewide in Florida.
Oh, exactly. Everyone, and I'm not going to talk about the media and everything, but I believe it's a self-fulfilling prophecy when you talk about the economy saying we're heading into recession. Well, then that starts shaking everybody's confidence and people are like, whoa, better not spend, better slow things down a little bit. It's almost they put out there exactly what's going to happen. And really, it's for guys like us, I think it'd be great. I'd love to see a little bit of a downturn, bring the prices down a little bit, weed out some of the trash in the market.
Yep. Well, one of my mentors who's worth several $100 million, and by the way, at this point in my career, unless someone's worth more than $100 million, I disregard their advice because I figure it's not advice that I can actually use. It's going to add another zero onto my portfolio. But what he said was really interesting. I remember he called the low point in the Dow Jones in 2008. He texted me and goes, bottom of the market. And I remember reading the text and I looked at the market. I'm like, how does this guy know? So I remember I took him out to lunch. It was a week or two later. And I said, you got to tell me how you know. It's like you have a crystal ball and you know. And he told me something really key about the economy. The economy is driven by one word. And I said, okay. And so I'm guessing all these words that were wrong. And he goes, no, it's spending. And I said, okay. And he goes, do you know what drives spending? I said, so I gave him all these words that I thought were right. He said, no, it's confidence.
Yep.
And so ultimately, if you look at an economy and you want to know what's going on, if there's lots of spending, that's what keeps the engine running because that keeps the entire supply chain running. When people are not confident, they close their wallet, they stop spending. So that ultimately, to your point, when the media starts scaring people and people start doing that with their wallet, that's when things spiral and go downhill. So the government has a lot of control over the economy, but the consumers do too, because by them simply closing their wallets, hoarding their money because they're scared and not spending, that dries up an economy very quickly.